Hey, this is Chris Creekmore, wherever the camera is. Hey, this is Chris Creekmore, Creekmore Realty Group, brokered by EXP, and I'm at the coast of North Carolina. I am joined today with David.Stokes, and he and I have been working together for years with Heckam for Purchase, and we happen to be working with a couple of clients right now, and he was showing me his amortization chart and the benefits of making a payment versus not making a payment and on and on. And I said, man, more people need to see this. So, so David and I have this short webinar. Thank you for watching, and shouldn't take too long. But I wanted to answer some questions that people typically have about a Heckam for Purchase. Just real quick, this is me in the left, and in my team of agents. We specialize in active adult communities here at the coast of North Carolina and vacation properties as well. So David is a retirement mortgage specialist. And again, I've known David for several years, worked with several clients over the years. But David, welcome, and tell the audience who you are.
Thanks, Chris. Good to be here. I wish I was at the coast. So my background is about 30 years of retirement income planning. I sold my financial company in 2007. I also had a mortgage company, which I got introduced to the reverse mortgage and then the reverse purchase program, which I've been offering that and educating people on that since 2004. And now I'm strictly basically focused on the reverse purchase program at this time.
Okay, awesome. Yeah, and worked very well with David. He's very responsive. I mean, he's just a good guy. So always enjoy working with David. So five questions keep coming up, and whenever I talk to people about a reverse for purchase type of loan, so wanted to go through some of these with you, David, and so that we can share it with other people and they can watch it at their leisure.
Sounds good.
So the big question is, what is a Heckam for purchase loan?
Yeah, it's an FHA program that allows people my age, 62 and older, to leverage the cash they have, which could be cash from a sale of a previous home, but it has to be cash that they have to help buy a home that they really want instead of a home that maybe they can afford.
Okay, all right, but it's only for 62 and older individuals.
Yep, but also somebody can be married to somebody 62 and older. Like had a client, she was 59, her husband was 68. So even though she's not 62, they can still use the program.
Okay, and this is the FHA insured program. So this program started back in the Reagan era, didn't it?
Started roughly in 1989, correct.
Okay, but it has gone through an evolution and improvement that is keeping people more protected on as till we got to the point that we are today.
Correct. Yeah, I mean, before 2014, if a couple did the purchase loan and somebody was 59, they would not have been protected if the older spouse passed away first. And now, because of all the great changes they've done, that's why now they are now protected with the program and never have to sell the house or make a payment.
And it's so non-recourse, never be worried about getting kicked out of the house.
That's correct. As long as they're paying their property taxes, homeowners insurance, and HOA fees, and keep it as their primary residence, never have to be kicked out of the house. Never have to worry about that.
Perfect. So let's just talk about the basic qualifications for this loan.
Yeah, as I mentioned, you got to be 62 or older, at least one person. If it's a couple, has to be 62 and older. Meet minimum credit property requirements. The credit requirements are fairly simple. They don't look at credit scores. They're just going to look at the credit history for the past 2 years. They're also, the lenders are going to look at if the couple has paid their property taxes, homeowners insurance, and HO fees on time for the past 2 years. Properties, 99% of all properties qualify Until we get to the last one, condos have to be already FHA approved before a loan can be done for a condo. And as you point out there, you can't be delinquent on any federal debt. And of course, the home has to be your primary residence. And the property can also be, besides single family homes, townhomes, and 2 to 4 unit um, dwellings, non-commercial 2 to 4 unit dwellings. The cool
Okay.
thing about
So,
that, Chris, is that somebody could buy a 4 unit dwelling. One of them's got to be their primary, and then they have 3 rental properties. So it's pretty cool.
uh, yeah, that is cool.
Uh,
But it has to be FHA approved.
yeah, and only the condos have to be FHA approved.
Right, right. So, spoiler alert. So, if you watched one of my previous webinars with Vince Bacchi on condos here at the coast, not many FHA approved. So, but anyhow, so let's so those are the basic qualifications. So good, awesome, and so let's talk about how does it work? Just so the basic nuts and bolts for a HECM loan.
Yeah, basically, so how it works is that based on what their age is, the youngest person's age, again, if it's a couple, they use the youngest age, the purchase price, and of course, interest of the day will determine how much that client's one-time payment has to be. They just make a one-time payment based on those parameters. And then if no additional payments are ever required, even though they can, make payments, and then based on their one-time payment, the lender will provide the rest of the money, just like with a 30-year mortgage, in order to buy the property they're looking for. So again,
So
go ahead.
yeah, so I have to be 62 to get the loan. Okay, but let's say I'm 75. So my down payment could be closer to 30% if I'm older and more if I'm younger.
No, so good point. So the younger you are, so my age, 62, I would have to put down about 70%. The younger you are, the more you have to put down. The older you get, the less you have to put down. So as you get older, you're going to have your one-time payment requirement is going to be less as you get older.
So this is great for somebody that's on a fixed budget.
Yep,
They need to move out of Pennsylvania, snow, whatever. And I'm 70 years old and I can't afford a mortgage payment, but I'm selling my house and I've got some cash that I can use. So really is an ideal program. And this is, I assume, why it was created for people who are 62 and older so that they can continue their lifestyle or even improve their lifestyle from where they're at.
exactly. That is probably one of the main ingredients why it was developed, is to continue in the same lifestyle that they were used to. But in some areas, homes aren't appreciating as they are in some other areas, and now they may not have that one-time payment to pay cash for it. But even that may not even be the best way to do it anyway. But by using the HECM for purchase, the reverse purchase, it's again a way to help leverage the funds they have to buy the house that they want.
Okay, so again, it has to be a primary home. You don't have to make a payment, so you can defer any payments, and is not required to take monthly principal or interest mortgage payments.
That's correct. They're just
Okay,
required to pay their property taxes, homeowners insurance, and HOA fee.
all right. So let's say I wanted to make a payment. I don't have to make a payment. We're going to go through an amortization chart, but so if I do make a payment, then that's going to build a line of credit, and it's going to also improve my equity. Is that correct?
Yeah, correct. So when you make a payment to a HECM for purchase or a reverse purchase, dollar for dollar, it's going to pay the interest on the loan, but dollar for dollar, it's going to go into a line of credit that's in the background. There's nothing in the line of credit until you make payments. And once you make payments, it goes into the line of credit, which also, because you're paying interest, is going to increase your equity that you have in the house as well.
All right, excellent. We're going to take a closer look at that because that I think is absolutely fascinating in the 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 advantages that are just not understood. But I'm grateful that you're here with us to explain that.
Yeah.
So, plus there's tax advantages. So if I do make a payment, I'm going to have some tax credit on April the 14th, 15th.
So you will get a what is that, a 1098, tax form that's going to tell you how much in interest that you've paid. Um, and there's a couple interesting ways of making payments. You can make payments anytime, as big or as little as you want. Um, and you'll get that tax information for if you itemize your taxes. But this program is still the only loan program where you can, if you do it the right way, you can actually get a very large tax deduction. For instance, I had a client, he saved up his payments for like an arbitrary payment. He decided what it was going to be. He saved it up for 8 years. 8 years later, he made a one-time $80,000 payment, which gave him a really large tax deduction that year. Now, that's something I talked to him about, but I told him to talk to his tax advisor. And he made that large payment. And what he did with it was he took money from his traditional IRA that was taxable and did a rollover with that tax break that he was getting. So now he has money in a Roth IRA. He has that is not taxable, and he has this large payment that he made that is also in his line of credit that we'll discuss a little bit later, and all the different benefits there, because there are so many different benefits tax wise that you get from making payments to your reverse mortgage purchase loan.
So this is absolutely brilliant. Again, we're gonna have to throw in this disclosure. Disclosure: this content does not constitute
Yep.
tax advice. Please consult a tax advisor regarding your specific situation. But there's some good benefits. You just need to explore them. And David
Exactly.
certainly can put you in the right direction when you contact David. Oops. So, all right. So the amortization on this type of loan versus a traditional loan seems to be quite different and has some big advantages. So a home equity conversion reverse mortgage, you're borrowing against build up equity in your existing home. With a reverse mortgage, your purchase or home equity conversion mortgage, you are purchasing a new primary residence and providing the required equity by way of a down payment at closing with your own funds. Once the loan is established, the benefits and features of the two products are essentially the same. So, walk us through that. What does that mean? Features and benefits are essentially the same.
Yeah, so the when you do a reverse purchase, which you qualify for, again, is based on the value of the home and the age of the youngest person. And then it's going to be, you're going to have a one-time payment, and then the lender is going to give you what you qualify for based on that value and your age. They're going to give you that money up front to help you buy that next house. And then with a reverse mortgage, you already own the home. And again, based on the value of the house, the youngest person, they're going to give you access to the equity you already have in the house that you can use in retirement. Once the product is in place, once you've bought the house or have the reverse for the home you own, then the other features are the same, meaning you never have to make a payment for either program. You never have to repay the loan while you're still living in the home. And if you decide to sell the house down the road, you never owe more than what you can sell the house for, because it's what's called a non-recourse loan. So those are some of the features they're talking about once the programs are in place for either a refinance or a reverse purchase.
All right. So this is a good opportunity. Let's walk through a couple of scenarios. So I'm going to have David share his screen and let's take a look at some options that we were discussing earlier.
By the way, Chris, I forgot to mention that this is the same information I used to teach for the Department of Housing, and I would educate realtors about this purchase program. And so this is basically the same information that I provided to realtors that we're now providing directly for the consumers. I always forget to mention that I was an educator for the Department of Housing for a number of years.
That is important to know because uh, David can walk you through every nuance of this particular kind of loan, and he really he taught it. He knows it. So, all right. So we've got a particular scenario here where somebody is attempting to buy a $400,000 house, and how old is this person?
Yeah, so let me back up. This person is 62, oh, I'm sorry, 68 years old. Did we want to do a 62-year-old?
No, we this is
Keep it
fine.
68. Okay. So it's for a 68-year-old, or it could be a couple with the youngest person being 68. Purchase price is 400,000. And based on that age, 68-year-old buying a $400,000 house with a HECM for purchase or reverse for purchase, they would bring a one-time payment of roughly a little over 265,000. The lender contributions from the loan, the lender would bring us about 135,000.
Okay. I have a house in New Jersey, and I want to buy a house, and I owe nothing on my house in New Jersey. I'm going to have $400,000. And so I pick up the phone, I call a realtor and say, I want to buy a house, but no more than 400,000 because that's how much cash I've got. So with this loan, I don't have to use all my 400,000. I use 235,000, something like that. So then I've got 165,000 that I can either make improvements to the house that I'm buying, um, pay down a medical bill, go on 7 cruises, whatever I want to do. But I don't have to take all that cash that I've got in the house that I've been living in for 25, 30 years that I finally paid off. I can use some of that money, buy a house that's 400, maybe 450,000, and not have to pay a mortgage payment unless I want to.
Correct. And why pay cash for it? Then you've locked up $400,000 in a house that you don't have access to. Where using the reverse for purchase is that you make a one-time payment based on your age, in this case, 265,000, and you have 135,000 that you still can play with. Put into annuity for lifetime income, like, and or some of the other things that you mentioned. Or for
Okay.
instance, Chris, real quick. So my dad, when he used this program 14 years ago, home prices were a lot less. He sold his house up in Annapolis, Maryland, sold a house with a reverse mortgage on it, cleared 200,000, comes to North Carolina, finds a $235,000 house. But based on his age and that purchase price at the time and interest rates were lower, he only had to make an $85,000 payment. Never has made a payment in 14 years. That left him with 115,000 left over. And because of my financial background, and I knew I was going to be my dad's caretaker, I used 100,000 of the money he had left over and bought a long-term care annuity that tripled in value immediately. These annuities double or triple in value. So now we have 300,000 in long-term care if dad ever needs long-term care coverage. A house that single story, easy to maintain, that he never needs to repay or make a payment on, helps with his cash flow. And he's just tickled pink. And I like what he said to me one time. He goes, shortly after the closing, he goes, so if we have another 2008 housing crisis, so what? I've only paid 85,000 for this house. So I was like, that's a good point, Dad. So, but
Well, yeah, go
uh,
ahead.
no, it's just that, he is a very I wouldn't say he's a typical client. He's probably about 20 to 30% of my clients were just like him. Just didn't have enough money for the house, or didn't want to lock it all up into the house itself. Also, plus once he found out there were other financial retirement goals he could meet with this program just opens up the door for doing so many other things in retirement that you never thought you could accomplish or meet those goals.
Yeah, again, this is a program that is designed for seniors, and there's lots of pros for that. Let's talk about a con that people, always talk to me about is when we're talking about a reverse mortgage. Will I be upside down on this house?
Right.
Okay, so let's talk about this model. I've put 135
You
roughly
put 100, you,
135,000.
the lender's going to give you that, the 135. The client put in, based on 68-year-old, 265,000 roughly for that
Okay.
$400,000 house. And, interest rates are adjustable, and most likely they're going to adjust down. That's what the industry feels. But even with that one-time payment, after 4 years, the client's going to have as much or a little bit more in equity than their one-time payment, and they've never made a mortgage payment. So, and they still have that other 135,000 in their pocket. If they had cash, they still have that 135,000 in their own pocket that they did something prudent with. And as you can see, the equity continues to increase because homes do appreciate. And, since there's also a shortage of homes, I don't see homes not appreciating for a very long time. But the home's appreciating, and it continues until what, year 16. So now this 68-year-old is now what, 68, 78, 84 years old. It starts depreciating a little bit, or it doesn't depreciate. The equity starts going down because now it is because the interest rate hasn't been decreased over here. It's starting to chip away at the equity in the house.
So we're talking before it really starts chipping away, you need to be in that house 20 years.
Yeah, I mean, it still has a decent amount of equity even after 20 years. It still has more
Well,
equity in 20 years than what it started at.
yeah, because at 20, I only put 265 in, and at 20 years, I still have
Yeah,
270,000 in equity.
exactly.
So, all right. So year 10, my grandkids had a fifth grandchild, or my kids have had a fifth grandchild, and they said, Mom, Dad, you got to come home. You had a great time at the beach. You played for 10 years. Now I need you back home because your grandkids want to see you. So in 10 years, see you more often. In 10 years, I need to sell the house at $592,000, and
Right.
I'll get
287
280. Um, and I only put
and 65.
265.
Correct.
Yeah, but I'll get 287 out of that.
And
Okay.
you've never made a payment in that 10 years.
All right. So we were talking through a scenario of on a mortgage payment, a conventional mortgage payment on a $400,000 house. Your monthly payment may be somewhere around $900 a month. And let's say I wanted to make that $900 payment not 12 times a month, but I wanted to make it 4 times a year. Okay. So if we plug that scenario in, 18, what's that,
36,
32?
30. So four, 900 4 times.
Yeah.
So 18. Oh, and that 30, would that be 36? 3,600,
Yeah.
right?
Okay. So let's say I wanted to make a payment of $3,600 each year. And let's say I did it just before December 31st. If there's a tax advantage that way, it sounds like there may be. Okay. So let's plug that in. And let's say for uh, every other year, I make a $3,600 payment.
Gotcha.
So I'm watching my line of credit. No, 3,600.
Oops, I gotcha.
Not 36.
Sorry. I gotta change that. I did got happy fingers.
Yeah. Yeah.
There we go. 3,600.
Okay. So I'm watching my line of credit improve as I make that payment. And
Yeah.
then what's it doing to my equity position? Is
Yeah.
it
So as you
increasing
can
my
see,
equity?
your line of credit's increasing, and your equity is also increasing. It,
Okay.
and if you stop making payments, I mean, the line of credit wouldn't, I mean, the equity wouldn't start going down until 18 years from now. And you still have a decent amount
So,
of equity.
all right. So I'm buying a 2005 built house. And I want to put money into a savings account because I know it's going to need a new roof. So I can put that money into a traditional savings account, which may draw interest at 4%, something in that neighborhood. It's lower than prime or whatever. But if I take that same amount and I put it into uh, my line of credit or making a payment,
Right.
I have $24,000 that I can use towards replacing a roof.
That's correct. So after,
Increase
because of the growth, and your line of credit growth today is growing at roughly 7.5% tax free,
7.5% tax free.
no fees.
Okay. Okay. So I am not 62, so I have a conventional mortgage. Okay. So I wanted to build a dock on the back of my property. So I called my lender and say, hey, I want to get a loan to against my house, and I wanted to use money to build a dock. They said, great, Chris, we'll give you the money, but we got to have an appraisal and you got to apply for the loan. So um, with this program, and I just want to replace the roof, and I need $15,000 to replace the roof. Tell me how that differs.
Yeah, you don't need to qualify for this. You already have the reverse purchase loan. And now with these payments that you're making, you're funding your own line of credit, really your own bank account that you can draw on any time. You'll get a package that explains how to set up your own online access to your line of credit. You'll go online, request whatever money you want. Within 3 to 5 days, that money will be transferred into your checking account.
All right, so let's take a look at this scenario where after year 10, after making 5 payments of $3,600, at year 10, I take $15,000 out.
So you got 15,000 in your pocket. Your line of credit is still at 10,853, and you still have equity of 200 and almost 298,000.
All right, so I'm replacing the roof because I know I'm going to sell the house and move back closer to the grandkids, but I know I need to replace the roof in order to sell the
Got it.
house. So I'm going to sell the house at 592,000
Right.
and then get 297 out of that house.
Correct. It's also good to point out, if you didn't have to sell the house and you took this money out of your line of credit, there is also no payment required to pay that back as well. I get that question a lot. Well, if I take money out of my line of credit that I've built up, do I have to make a payment? Nope, never have to repay that money as well. Not until you
So
have sold the house. And of course, from the sale, the loan, this 15,000 you took out was added to your loan balance. And from the sale, the loan balance is going to get paid back, and you're going to get the remaining 297,000 in equity.
so on my line of credit on my house, I have to make monthly payments on the amount of money that I borrowed
That's
against
correct.
my house.
That's correct. And your line of credit most likely doesn't grow over time.
Yeah.
Also,
So
the line of credit, they cannot ever take this away or reduce this like they were doing back in 2008. Your line of credit is, irregardless of what happens to your home value, irregardless of that you don't make a payment, they can never reduce your line of credit or take it away. Only you can reduce it by taking money out of it. That's another big
so
difference between a traditional line of credit and the reverse line of credit.
So I don't have to make a payment, but there's some big benefits if I do.
Yeah,
And I certainly don't have to make 12 months payment.
nope,
I can make one. I can
correct,
make four, whatever I want. Whatever I've got some extra free money. I want it to grow at 7%, so I can dump it in towards my line of credit.
correct.
Yeah. So I mean that's a great program.
Well,
Um,
there's something interesting can I share it, Chris?
sure. Yeah.
So, you were taking the 15,000 out to replace the roof because you were preparing to sell the house. But as I mentioned, I had a client that made a one-time payment of $80,000 to get a really large tax break. So he did that, but now that money is in his line of credit growing, and down here in year 15, he'll have 231,000 in the line of credit. So he was roughly, again, about 62 when he started this program. And 15 years down the road, he's 72, 77 years old. And he's got 231,000 that he can draw from. He can also turn that money into tax-free distributions for the rest of his life while he's still living in this house. And that would be about 17,000 tax-free that he could get. Now that's a high level discussion, but this program can also be used to turn your line of credit into tax-free distributions for the rest of your life, as long as you're living in the house, paying your property taxes, homeowners insurance, and HOA fee. That's pretty powerful. You know, things don't get cheaper as we get older, and the line of credit is just a nice way to help buffer against inflation and the cost of things getting expensive, because they're not going to get less expensive.
So if I sold my house in New Jersey for $400,000, I need 165,000 to buy that house, leaving me with $135,000 in cash money that I can, do whatever, go on a cruise, whatever. But let's say I wanted to take 35,000 of that and put it back in towards a house. Would I do that day one, or should I wait a little bit of time to do that?
You would need to wait until after the loan has closed, and then you'll get your first monthly statement. Once you get your first monthly statement, you can start making payments right away.
So if you can, just for the sake of it, on year one, put $35,000 in there, okay, and change the other monthly payments to zero.
Okay.
I still have $100,000 that I can pay off a medical bill, put into my grandkids' college fund, whatever I want to do. And
Correct.
so then that $35,000 after year 10 is now 60, almost
Yeah, almost 65,000.
$5,000. Yep. Wow,
It's a
that's
really
pretty powerful.
powerful tool because you can do whatever you want with it. And I do have some clients, they'll take a vacation here and there with their line of credit that they have because they're preparing to take the vacation. So they've told me, we put about 7,000 in our line of credit each year and let it grow. And then about every 3 years or so, we take a vacation with that money that we have in our line of credit. And then I've had other people tell me that, that they're funding their line of credit to help prepare if they ever need assistance with long-term care, because they don't have long-term care insurance. And this is a great way to help supplement what you're going to need for to pay for the assistance of long-term care, whether it's in-home long-term care or a spouse needs to go into long-term care assistance. It's a great product to be able to fund it tax-free to help pay for that. And if they
Excellent.
never need the long-term care, like, long-term care insurance, if you don't use it, you lose it. With this, if you don't use it, it's extra equity that you've put in your house that you're going to leave to your heirs.
So I don't have to deplete all the cash that I have in a house that I'm selling in New Jersey. I don't have to make a payment, but if I do make a payment, I have some tax advantages to that. And also I am building a line of equity, line of credit that I can use for house repairs or vacations or whatever we want to do.
Again,
So
the tax advantage there is that there's no taxes you pay on this money that you're taking out. It's not taxable.
that's excellent. So David, it's an excellent program. I wish more people knew about it. And in our last screens, we'll have how you can reach David, and also in the text below the YouTube, you'll see how to reach David.Stokes, as well as us at Creekmore Realty Group. Is there anything else you would like to share with us?
No, I mean, just, contact Chris and find a first get, contact Chris, tell him what your plans are, what you're looking for, and then let me pre-approve you. The pre-approval process, I have a one sheet pre-approval sheet that you fill out that I can pre-approve you with, and give you a pre-approval letter. That way Chris can start showing you these homes that you qualify for, and just start enjoying retirement.
Yes, that's the whole name of the game. Don't be stressed and enjoy your time. So that's excellent. Thank you so much, David, for joining me again. This is Chris Creekmore, Creekmore Realty Group, and we are your realtors and guides for active adult coastal living. At over 30 years or nearly 30 years of experience, my team combined, we're over 30 years of experience. We can help you buy, sell, retirement, relocation, second home. We do all of that. So please do reach out to us. David.Stokes information is below this YouTube video. Also, you've got it right here on the YouTube video. Just push pause and write down David's information. Again, thanks for joining us, Creekmore Realty Group and David.Stokes. And we look forward to your phone call. Thank you.
Thanks, Chris. Have a great one.
All right. Thank you.